Good morning and welcome. We are so glad that everybody is here. My name is Karen Goldner. I'm the Managing Director of Established Business Services for the Women's Business Development Center at our headquartered office in Chicago. I'd like to introduce a couple of my colleagues, Sarah Brooke, who is the director in our Minneapolis Twin Cities office, and Cynthia Johnson, who is the director in our Chicago office. I also want to thank our sponsors, Barnes and Thornburg and EisnerAmper, who have just been tremendous partners in the creation of this program. The program is being recorded, and as has been the case so far with our previous sessions, it will be shared after the program is over later today, along with contact information for our guest speakers. Sarah, if you want to pop up the next slide, I want to just remind everybody that we really have divided this very complex and topic into a couple of frames. The first, which we talked about last week, was internal options. So selling to management, selling to family, selling to people you already know. Today, we're going to be looking at external options, which is selling to a strategic buyer, some other type of unrelated buyer, and a little bit of a discussion of private equity. Next week, which will be our last session, we will be talking about certification. What does selling a business mean for your WBE, Women's Business Enterprise certification? So without further ado, I would like to introduce and welcome Michelle Martin from EisnerAmper, who's going to facilitate our panel.
Karen, thank you so much. I'm really excited to be with you all here today, and we've got a couple of fabulous panelists to help us learn more about external buyers, private equity, and really navigating the marketplace. I'd like to introduce, we have Brad Frank, who is a partner at Barnes and Thornburg. He's been instrumental, and I think you've been on 2 or 3 calls now, Brad. So
this is my third.
This is okay, great. And maybe you can just introduce yourself and give a little background just to update the group.
Sure. Hi again to some of you. Hello for the first time to others. I'm Brad Frank. I'm a partner in the Minneapolis office of Barnes and Thornburg in our corporate group and our private client services group. And I work with closely held and family-owned businesses sort of across their needs. And I also help my clients with estate planning and sort of more advanced gifting. Barnes and Thornburg is a 22-office law firm with about 800 legal professionals and cover sort of the gamut of people's legal needs. I'm happy to be here.
Thank you, Brad. And I'd also like to introduce Corey Markley, who is a partner of mine at EisnerAmper. Corey, if you'd like to share a few thoughts.
Yeah, thanks for having us, and thanks for everybody for inviting me into this conversation. I'm a partner in EisnerAmper. I lead our transaction services desk. We have 15 individuals across Minneapolis and New York that works predominantly on buy and sell side acquisitions. We are a due diligence provider to private equity funds, family offices, strategics, family-owned companies. We kind of work across the spectrum of buyers and sellers and investors. A little bit about Eisner itself. I think prior to the integration in September, we were Lurie, a 225-person firm. Now we're a 3,000-person firm with coast-to-coast presence. So definitely a change, and in the last 6 months with us. And it's a timely topic for our group internally, but also as you guys think about exiting in the next 2 to 5 years.
Great. Thanks, guys. So I'm fortunate enough to work with Corey. We've worked on several transactions together, helping people begin to navigate that process. And I work in the wealth management division of EisnerAmper. I lead our Minneapolis office and had been part of Lurie. I've been here for about 8 years. So again, like Corey, our practice has grown dramatically as we've become a part of EisnerAmper, and we have offices across the country as well. So with that, I am really excited to start this discussion and dive in to figuring out what it looks like to navigate an external buyer. And I'm going to pose this first question to both of you. And really what I'd love to hear is, some cases of that you've worked on for sale to a strategic buyer or an unrelated purchaser, or possibly even private equity. Give us some examples of what that looks like, and then maybe some major considerations for each of those. Brad, I'll start with you.
Sure. So, I think the way I've seen clients approach it and their advisors approach it, and we approach it, as far as what is likely to be the best fit for a given seller, sometimes has to do with, or mostly has to do with what you want out of the transaction. If what you're looking for is sort of the highest multiple, the highest purchase price, depending on the size of your business, that may well be a private equity transaction in today's market. But sometimes if your business is a little smaller, and or if you're looking for somebody who like really deeply understands your business and or might see the value in what you provide in a way that a financial buyer might not, a strategic, somebody, most often who's in your business is going to have a good understanding and maybe the best option for you. Like right now, for example, I'm working on a transaction with the buyer is likely to be a strategic in this case. The client is going through a full process, but this client has a very high concentration with a single customer. Their one customer buys like 70% of their output or so, and the sort of feel they had going in, but that their investment banker is sort of reiterating to them is that strategic buyers are most likely going to be the ones who can get comfortable with that and pay the most for that because they sort of understand the broader market and how this might fit into the market a little bit better. So, we're seeing that, but, other considerations I think that come in when you're looking at the differences among these options can be how important to you culture is and the maintenance of a culture after you sell. At some point, usually it's healthy to sort of understand that you won't control that anymore. But I think some of our clients, when they sell, see the best chance of that surviving via a strategic kind of transaction rather than private equity, though that's not always the case. As I mentioned before, for some people, it's just like, how much can I get out of this and just seeking that. We'll talk more about how private equity tends to structure transactions, I think, throughout this conversation, but some people really like, a lot of private equity buyers will offer the sellers kind of, what they describe as like a second bite at the apple through some of the way they structure the compensation you get in the transaction. So some people like that part of it and can enable you to maybe get more for your business ultimately. And then also, in my experience, if it's like important for you for the transaction itself to move very quickly, or relatively quickly, in my experience, private equity is much better at achieving that than strategic buyers can be, just because larger companies tend to move more slowly and have different layers of decision makers that have to be involved. But so that's sort of a general set of thoughts I had. Corey, I don't know what you're thinking.
Yeah, I mean, personally, I really think it comes down to, this is a first generational business, which I'm imagining a lot of the individuals on the calls, it is. It really comes down to culture and fit and really what you want on the transaction itself. Now, I've worked with a ton of private equity, a ton of family office, strategic buyers. There's good and bads in everyone. And you can't just have a blanket trope that says private equity is really good or really bad, because there's really good private equity and there's really crappy private equity. There's really good family office. There's really crappy family office, right? There's really good strategics. There's really bad strategics, right? So you really need to do your own due diligence on those buyers or investors to understand what the culture is, what the fit is, and what's important to you, I think, and to the company itself. Is employee retention, is that important to you? Is maximizing value important to you? Is it a combination of those two? So there's a ton of variables that go into choosing a partner, a capital partner or a buyer. So I just encourage you to sit down and ask those pointed questions to whoever you're talking to. And then, after that, once you're comfortable with maybe their business model or their investment thesis, then you can kind of sit down and figure out kind of what's the best option. And then everything else kind of gets figured out during the transaction itself. A lot of people want transparency of what this is going to look like. I think Brad will contest to this, that there's always unknown variables that pop up during that. And you just kind of work through that. And a good capital partner, a good buyer is willing to do that. And if they're not, I would say maybe they're not the best partner. And maybe you need to reconsider what kind of values you have and what kind of values maybe they have.
Excellent. So Corey, just a continuation of that, as you think about, possibly the due diligence process and thinking about the highest price and culture and some of those factors, what are some other areas from a due diligence standpoint that you believe it's customary to ask about, and where I'm going with that is highest price versus maybe the most secure repayment. The structure has a lot to do with it. What do you find is really private equity is one piece, but just an external buyer? What's the norm in terms of what a seller should be asking for? Disclosure around due diligence.
Yeah, I think it's benefit for both parties, specifically for the seller itself, to understand what the buyer's due diligence process is going to look like, right? And that's, from quality of earnings to tax due diligence, possibly environmental due diligence, human resources. And there's a number of due diligence streams that happen during a transaction itself. And I think it's beneficial for the seller themselves to understand what that's going to look like, understand how that plays into the purchase price. Is there contingencies related to that? I mean, there's 100 variables that come into this. A lot of times those get worked out through the LOI. I think, as Brad will talk to here in a little bit. But those are the big streams that I think people understand. Networking capital also is another piece that I think sellers tend to forget about. As part of that purchase price, you need to be delivering, a certain amount of assets and liabilities, sometimes even cash at close, and understanding what that looks like. And if you can't deliver those amounts, there is potentially, a purchase price adjustment that happens depending on, what the LOI and the purchase agreement dictates. So there's a number of things that advisors can help you with throughout that process. But I mean, just kind of going back to, I think, my initial thoughts on figuring out what's important to you and making sure that, a transaction is structured around those important value points that you want, considered. And like I said, sometimes it's price, sometimes it's structure, sometimes it's more, community friendly things, employee retention, certain amount of benefits left behind, things that, are culturally, more acceptable in today's world. Brad?
Excellent. Go ahead, Brad. Do you have anything to add to that?
Yeah, sorry, I was muted.
No worries.
No, I was going to say, sort of on the flip side of that too, as the seller, I think it's reasonable if the buyer is asking you to provide some seller financing, take some of your proceeds on a note, or I don't know how much we'll talk about earnouts today, but an earnout, which is, giving you further compensation based on the performance after closing of the business you sell them. I think it is, to your point, Michelle, reasonable to do diligence on the seller, on the buyer, and ask them, how are you going to assure me, and how are we going to ensure that you make these payments if we achieve the, whatever milestones might be required. And, that can turn into looking somewhat at their books, or whether there needs to be a guarantee from some other entity standing behind the transaction. And also, if you should take a security interest in some of the assets you're selling, or a pledge back of the ownership interest you're selling. You never, or you really don't want to be in a position where you have to take the business you just sold back. But it's good to set up protections and incentives to make them want to follow through. If you go through the process and they push back on those concepts, and either because of what you see, you start to get worried that they might not be good for it, or just because of the way they react, you worry. That might tell you something about whether these are the right partners for you in any event.
No, excellent. And I think that's really it. I think sometimes too, we can get caught up in timelines, and you've gone down the road or down the path quite far with a potential buyer. And then there's a snag as it relates to potentially, the transaction structure, or to your point, maybe how they're able to finance or get the transaction finalized. With that being said, another question, just from my perspective, is what is realistic with the different types of transaction? Brad, you mentioned it a little bit on timeline, but what should someone be thinking about once that external, maybe a or multiple external buyers are recognized?
Like, how long would it take?
Yeah, what's a typical timeline? that
Yeah,
people
that's a
can
good-
expect?
That's a good question. So, so from, I think I usually would say to clients, if you're going to run a real process and engage some sort of advisor to help you, market your business and sell your business, I think you can expect kind of getting ready. Again, I don't love the analogy to selling a house, but it is somewhat comparable, sort of getting the house ready for sale, listing it, closing. I think you can expect that to be certainly at least a year-long process, if not a couple. But from the time that sort of the buyers are at the door, and you might enter into a letter of intent, most letters of intent we see nowadays have what they call an exclusivity period, which would be the amount of time where the seller agrees, we're not going to talk to anyone else for this period of time, and we're going to work on this deal together. Usually we'll see that be up to like 90 days, but oftentimes it's much shorter than that. And sometimes that's strategic because you want to make sure these people who say they want to buy your company really want to buy your company, and they're not going to mess around for 3 months, 4 months, 5 months and not go forward with the transaction. But so, I think, and I recognize it's a large range, but I think sort of once the ball gets rolling and you have buyers at the door and a real deal on the table, I think you can expect that it would close. And again, there's a wide range, but anywhere within like 3 to 6 months. I think would be kind of normal. Corey, I don't know what you're seeing out there nowadays.
Yeah, there's this concept, that gets thrown around a lot during transaction called what is market, right? What is market? There is no real market to be fair. To Brad's point, from start to finish, when you start up, let's say you go to market with an investment banker and it could be easily a year long. I'm working on a couple of transactions right now that are approaching a year from start to finish. I would say that I'm seeing longer due diligence periods right now, especially in the back half of 2022, going into 2023. You're seeing buyers being much more diligent about their investigations and their own due diligence on the companies. There has been a shift in earnings and in revenues. I've seen the last 6 months now with things slowing down a little bit. And buyers making sure that they're not buying at the peak and making sure that they're kind of paying fair market value or intrinsic value is what maybe we call it in our world. So I would expect due diligence processes to run maybe a little bit longer than maybe what was happening a year ago to 2 years ago, when it was just kind of chaotic and forensic. And Brad and I worked on a transaction that had that kind of feel maybe about a year and a half ago with a mutual client of ours. So I would say that, a year from start to finish is pretty common. And then once you get an LOI, 60 to 90 days is kind of the norm that I'm seeing now. But it's not uncommon to see extensions beyond that, where both parties agree that, hey, we'll do 15 or 20 or 30-day extensions if we're hitting certain milestones throughout that process. So it's kind of a long-winded answer to there's supposedly there's a market for it, but there really isn't a market for it.
Yeah. Thanks, you guys. I think that's helpful. And kind of along the same lines, Brad, so one of the WBEs asked if all the emails received from interested investors are garbage. And how does a credible interested party actually make that initial connection?
Yeah, the answer is, are all those sort of interested party emails garbage? I waver between maybe and probably, but not necessarily. I mean, they really could be for real. I mean, I honestly can't recall having having helped a client sell their business to a truly unsolicited offer. And so how do people like really find people? In my experience, a number of ways. One is sort of, if it's very intentional, and you, like Corey and I have both said, and we've heard in other of these presentations, where you run a real process and engage a business broker or an investment banker, and their job is to go out and find buyers, right? But if it's more organic, oftentimes it's someone through your industry, and maybe you see them at a conference, and you start to hear rumblings that they're looking and you're looking, or your friend sold to somebody similar or to these same people. So that often it can play out. I've seen situations where somebody has a large customer who maybe probably, if they think through their own supply chain, probably should own this business, right? And so I've seen that, or an important supplier, like same kind of ideas. And then also a lot of times we'll see people get approached because their lawyer knows somebody or their accountant knows somebody who's looking for a business of their type. In fact, that there's a EisnerAmper client who I know, who's not a client of mine, but who I sort of know personally, who has asked Eisner to kind of put out a one-pager saying, hey, I'm looking to buy these kinds of businesses, right? And that can, and you send it out to, you guys send it out to lawyers and other sort of advisors to privately held businesses, and to some of your clients, I'm sure, and say, hey, this person's out here and he's interested in paying up to this amount if it works, if it feels right, in these types of businesses. And I think those sort of warmer introductions are more likely to lead to a real path towards a transaction, as opposed to just straight up like, hey, I want to buy a business kind of thing.
Yeah, that makes total sense. And, just kind of expanding on that question even a little bit further. So one of the participants had a question, if you have a 2 to 5 year exit plan, and you're thinking about this, as we think about private equity specifically, how should that be approached, if that's really your focus, and when should private equity be brought into the conversation?
I'm sure Corey will have probably even more useful input than I would on this one, but I'll start by saying the way the private equity is most likely to get brought into the equation is through some sort of likely an investment banker, at least in my experience, because they have the connections and they just know the broader market, and there's a lot of private equity firms, some of which I would actually call private equity firms, some of which call themselves private equity firms and probably aren't private equity firms. But there are a ton of them out there. A lot of them have money to spend, but it would be just totally overwhelming and daunting to try and guess at what your world is that you should be looking at. And so, again, I think up at least a year before you sort of want to get the check, you probably want to start the process. And a big part of what investment bankers do is they know that world, or they're supposed to know that world, and they know who within that world is interested in what industries and what types of businesses and are paying what kinds of multiples. And actually, like Corey was saying, are like good ones to work with, not so good ones to work with. And they can help winnow that down, and then help you with a very targeted marketing campaign towards those potential buyers. So I think, and it's one of those things where I may have said this on one of the other sessions, but my point of view is like, especially those are the types of buyers you're interested in. If you're going to be for sale, you should be for sale, and you want somebody out there drumming up interest and trying to get as many offers as possible. And again, I think if you're looking at private equity, that really, again, I think an investment banker or a business broker type who has those contacts is really, really useful.
Excellent. Excellent.
Yeah, I would add on to just Brad's comments. I've told clients, especially first generation clients, that if you're interested in learning more about private equity, or let's just call it private capital, it's across the spectrum. Your advisors, before you even go to a process, can at least help you make some introductions to people that they know and trust or have worked with, and just have a conversation with them, right? Those private equity funds, those family offices are more than happy to come in and have just a conversation with you about how they operate, what assets they own, what their expectations are. There's no cost to that. It's really an experience for the management teams of these companies that are contemplating going to market to learn a little bit more about private capital and have a face-to-face conversation. Because once you get into a process, and I think Brad will attest to this as well, there's not a lot of time to rub elbows, shake hands, and become friends, right? You're going to be a partner in this typically, because a lot of times founders are asked to roll equity back in. So I often tell clients, and unfortunately they don't always take this up, is go meet some or ask for introductions and just have a conversation with them, especially private equity funds or family offices that already own assets similar to yours, that maybe understand the industry or have connections. And even if they're not a great fit, they may know some folks that are a great fit. So there is a little bit of a due diligence and investigation period that I encourage sellers to do during that. And don't just rely on your investment banker, because not that all investment bankers are bad, but they are motivated to sell the company because there typically is a contingent fee. And not that they don't have your back, but I would encourage sellers to do their own investigation too, outside of what the investment bankers are.
Yeah,
telling.
totally. And I would also add that the private capital, many of them will often offer up like references essentially, and they're more than happy to introduce you to other people whose businesses they bought. And they can tell you if what is being told to you is true.
That's excellent. And along those lines with private capital, Corey, what size catches private capital's attention? I mean, where is it where you're going to get the door shut on you every time you make, what's the entree point? I know it's probably really broad, but is there a kind of rule of thumb where someone could say, I really need to go down this strategic buyer, or, sell to a strategic buyer versus spend time trying to get private capital or engage with a private equity firm? Is there a size or thought process you have around that?
Yeah, it kind of depends on the size of the business. To your point, Michelle, it's very, very broad. If you're a platform company, if you're a sizable company, let's say a couple $1 million in EBITDA and above, let's say $3-4 million of EBITDA, you may be a really nice platform investment for a private equity fund or somebody in the private capital arena. You start getting smaller to the 2 and the 1s and even below that, those tend to be more add-on acquisitions to existing platforms that are out there. Either on a private equity side that owns an asset, and they say, hey, it's a small add-on, we like the business. I just worked on one with our client here that was less than $1 million in EBITDA, right?
Okay.
But they are a $48 million EBITDA company, right? So, but they see some nice upsides, a small company, they can fit it in. So you do see that. I just wouldn't expect, a sub, call it $1 million EBITDA company to probably be a platform. Typically, it'd probably be more of an add-on acquisition to an existing asset. And sometimes those smaller deals, those smaller assets are really good for probably some of the conversations you had earlier about maybe moving it to someone you already know, because the cost to transact is much less than it would be if you engaged a broker or investment banker to help you through that. Brad, any thoughts on that?
Yeah, no, I totally agree with that last point in particular. I tell clients this at the beginning, when clients always want to know sort of fee quotes and all that, which they should at the beginning of a transaction. And I tell them, honestly, that the difference between let's say $5 to $10 million transaction and the difference between $100 million transaction from a sort of process, when we start the transaction, like the professionals get going to the closing, isn't like hugely different. And so I think, and therefore the cost of it isn't hugely different. So I think, yeah, if you're sort of on the lower end of EBITDA, I would agree that it kind of might make sense to look at non-third party options first, because I think you might get your biggest bang for your buck that way.
Perfect. So we have a question, and I think it's always language and making sure that we all understand definitions the same. And I have two questions for you. Either one of you can take this. So the first one is really just clearing an EBITDA definition for the group. And then also, Corey mentioned a platform company. So understanding specifically what you're referencing with a platform.
I'll let Corey take EBITDA.
Okay.
Yeah. So EBITDA is nomenclature in the world of finance, and it stands for earnings before interest, taxes, depreciation, and amortization. It is a proxy for operating cash flow, and buyers will use that as a gauge of how much cash the business is throwing off during a particular period. And they use that in their valuation considerations, and will typically put some kind of implied multiple against that to kind of get to what they call a purchase price. So for instance, if you have an EBITDA of $1 million and someone's willing to pay 4 times that, they would pay you $4 million for that $1 million worth of cash flow that they're expecting. What happens is during the due diligence process, that EBITDA number will be vetted and making sure that it's ongoing, and there's no other, I won't say accounting tricks, but either non-reoccurring revenues or non-reoccurring expenses. It'll be adjusted for compensations considerations. I mean, there's a number of factors that go into it that we can take offline if people are interested in learning more. But it is kind of the number that I think the industry uses to strike valuations, and how they get there sometimes is more of an art than a science.
And you hit on one thing, Corey, which I think is really important. Compensation is something that's factored in there. And I don't know if we want to do that in the breakouts, but particularly when you have a principal that is, pretty valuable and probably taking up a lion's share of the compensation in the firm, how would that be approached?
Yeah, go ahead, Corey, and then
I mean, it's a negotiation. It's just like everything in a transaction.
Okay.
What you're getting paid today owning that company could be very different than what you are getting paid as a minority owner, or maybe just an employee, depending on how the deal is structured going forward. So it can change. If it does change significantly, I've always said that, well, that should get factored into your EBITDA number, right? Yep. To make sure that you're getting paid for that, for those dollars that you're no longer getting paid. And there's numbers of ways to structure that. But yeah, effectively, it's more of a negotiation than a science. Brad, anything to add to that?
Yeah, no, I totally agree with that, and with the second part that you should get credit for it if they're going to knock it down. To answer the platform question, so in sort of that's really generally a private equity type concept, or at least in the way we're talking about it. And the idea is private equity, their sort of general business model is to take a look at a given industry or a niche within an industry and decide we think we can build up something that the whole is worth more than some of its parts in a given area. And the way we're going to do that is normally they're going to start with what they call a platform company, where they will buy, let's say the industry is widgets, right? And so they'll buy something that's large enough that it can stand on its own and be competitive in the way they want it to be competitive in the widget area. So a relatively larger business within that space that they're interested in. And then what they do is the next step is, okay, we've got this, we've got it up and running, we're branding it, we're sort of streamlining it in the way we want to. And then, we have all this financial expertise that we're going to apply to this business and see if our plan works, right? And then we're going to go and buy up usually relatively smaller businesses in the same space. And those are the add-on transactions to this platform. And then, frankly, the play in private equity generally is to turn that platform through the addition of the add-ons into something even better and bigger, and then sell it to a bigger private equity firm or a strategic, somebody who's in the business as just a bigger player in the business. And so that's what we mean when we talk about platform versus add-on.
Excellent.
Yeah, and you're probably
Funny.
so you might hear the concept too with that called buy and build. They buy a platform and then they build it up through a number of acquisitions. So if you hear that concept, it's the same thing.
Okay, great. So here's another question from one of the participants. Does the value, Corey, if I can address this to you, does the value to the original owners, assuming that they're going to stay in place, really diminish if the partnership with the private equity firm raised the revenue threshold well beyond what could have been done without them, say in 2 to 5 years? So, in other words, just what you're saying, Brad, you partner with a private equity firm and this thing takes off, and what does that look like? What does that look like for you as a seller or the original owner if you're still participating in the business?
Yeah, I think it all depends, right? Top line revenues just doesn't. Let's go back to the concept of EBITDA. You can increase your revenues by 10%, but if your expenses increase by 15%, net your EBITDA is falling off, right? Again, it goes back to, has this operator, has this private equity fund or this buyer operating this industry, do they know how to grow it, right? How are you going to control expenses? These are all kind of due diligence questions that I think sellers need to get comfortable with, prior to choosing a capital partner or a buyer. When, a lot of times in these transactions, sellers will be asked to roll some equity back into the deal itself. The market right now is anywhere between 15 to 20% of the proceeds or the value that's struck. There are ways to understand what that looks like for you. But again, it's really kind of depends on what's the outlook of the business, the industry, how, do you believe that there's going to be 10, 50% growth? If you don't believe that, maybe it doesn't make sense to roll as much back in or try to negotiate something different, right? So the value of the business today versus the value of the business in 5 years is more of a concept that you just have to understand is what's the industry doing and how comfortable are you with the growth targets to get to that number, going forward.
Okay, thank you. Corey, that's really helpful. I'll just, Brad, ask a question of you. Gloria, one of the participants, just sent in on the chat, kind of following back on that platform question. Is an add-on sale the same as an asset sale or similar to that?
Yeah, not exactly. Again, the asset sale. So generally, all these types of transactions we're talking about can take legally 2 different forms for the most part, either an asset sale or a equity stock sale. The add-on and the reasons for that may vary from tax to whether certain agreements can be transferred to liability issues, all different kinds of things that come out in the negotiation and due diligence process. The add-on idea, again, to these platform type companies for certain buyers, for generally private equity buyers, those can take the form of either an asset sale or a stock sale.
Mm-hmm.
It kind of, again, depends on lots of things. So I guess the answer to the question is no, not exactly, though. They can come into the same conversation, but they're really 2 different ideas.
The asset or the stock sale is the structure of the transaction.
That's right.
Versus the strategic buyer equation.
That's
exactly. Right. Okay, great. Thank you. So, Corey, I'll address this one to you. So, at what point do you need to worry about when financing fits into a transaction, and what does that look like typically?
Well, I think it kind of depends on what you mean by financing. If you're asking about seller's notes, or if you're asking about rolling over a certain amount of equity into the deal itself,
I
it's something
would
that,
start, I would just start by, if it's simply a seller's note versus bank financing. And in my experience, bank financing can definitely extend timelines and extend complexities potentially. Maybe starting there, I think is my perception of kind of where we'd go first on this.
yeah, so if let's just talk about seller notes. Seller notes,
Yep.
the beauty of a seller note is that it can be structured between the buyer and the seller how they want it to be structured, right? Longer dated periods, or, if you want to go below market interest, there's a number of ways that that can be structured. I would say that those are conversations that you start having right away if you have someone that you're interested in being as a capital partner to bring out. And it's typically recorded in the LOI. There's some type of verbiage or line item that talks about the seller note, what the structure is going to look like, interest rates, amortization periods. You don't want to get hit with that at the end, because it's telling you that they can't raise the capital to do the deal itself. Brad, any questions on that?
Yeah, no, I agree. And I think one thing you want to look for if you ever get presented with a letter of intent is sometimes you will see a financing contingency that says, this is contingent on us being able to get the financing we want for this transaction. A lot of the times it won't be there, or they'll be one of their selling points is that they don't have a financing contingency. And they're ready to pay cash at closing. But I agree with that. And then this kind of dovetails back into what we were talking about before about on the seller side doing some diligence on the buyers. And again, like Corey just said, if they're asking for all kinds of financing options, and or they have sort of complex financing going on in the background, that may give you some pause about being their lender, essentially, right? And wanting to understand where you fit in their overall financing structure, because I don't want it to be this way, but when a client sells, and if there's either a seller note of any import, or an earnout, which just to define terms again quickly is sort of usually it says, we'll give you X amount at closing, but then also for some period after closing, if the company performs above a certain threshold of EBITDA or other certain thresholds, we'll pay you some more. But that in itself is a way of financing. I think I tell clients, you should try and get comfortable with whatever cash you get at closing possibly being the only thing you receive from this transaction. Because, I certainly hope that's not the case. And honestly, in most cases, that isn't what happens. You get the more, but you might not. And so I think it's important to understand not only the financing that's being offered to you, but to the extent you can, the financing that's sort of behind the curtain. So where you fall in the pecking order and how to protect yourself, to get as much protection as you can for what you hope you're going to get.
Yeah. I'll say one quick thing on that.
Sure, Corey, please.
The market is changing right now. I mean, it's getting harder to get senior debt lined up so you're better off getting in front of these issues now versus waiting towards a middle of a transaction, because it is getting harder and harder for banks to land against some of this. Some of it has to do with valuation. Some of it has to do with they're just getting worried of what's going on in the economy. So it does make sense to get ahead of it sooner than later.
Banks do tend to tighten a bit in slower times. That's pretty common, and they start to get a bit more selective. So that's a really good heads up, Corey. Did you have something else, Brad?
Yeah, I was going to say kind of to that point too, and I think Michelle, this is something you kind of touched on earlier. Though I don't know that you use these words, but there is sort of phenomenon is kind of overplaying it, but there is an aspect of these types of transactions of all sizes where at some point most parties achieve what professionals refer to as deal fatigue, And you kind of get to a point where, and I've had this happen a number of times over the years, where it feels like we're all kind of closing on this transaction just because we made it this far. And it's sort of like people don't even really care if we close or not, you know, and you don't want to get to, you know, if you're looking out for yourself and your best interest, you don't want to get to a point where if like an issue with financing comes up and you either in your mind have already spent the money or you have, you just sort of like, well, the cat's out of the bag, we got to do this deal now. You want to protect against getting to a point, particularly with third parties, I think, where they can start kind of trickling in these other issues, whether they knew they were coming or not. And you kind of have to say yes or feel like you need to say yes. And you know, financing can be one of those. And sometimes it's just, you know, again, market conditions, and it really truly isn't anyone's fault, so to speak. But sometimes it starts to feel like it might be.
Right. Right. And you hit on a point earlier, and we talked about this a couple of sessions ago about the, you know, the aspect of planning personally. And I think you bring up a really good point, Brad, about, you know, so run a couple scenarios. The first and primary scenario being, what is my cash at closing? You know, what am I certain of? And then, you know, run a scenario B and a scenario C based upon potentially, you know, earnouts or seller financing, those things that are not clearly, you know, bird in the hand. And that gives you a lot of assurance that you actually are doing something that makes good sense for you. So not that those don't have value, they do, but market conditions can change, things can change. And so it's really good to think about it, not as a for certain with everything that's there. And I see that with some clients that I'm working with now. They had some equity that they put back into the company as part of the transaction, and they essentially sold their business literally at a market high. And so they're totally content. We've literally discounted that additional equity in the company. It's there and it's significant, but at the end of the day, they're not worried about it. And I think that's a really good place to be as you start contemplating your transaction. So Corey, all this kind of leads up to the tax man and really understanding tax considerations and how they affect the proceeds, the structure. Do you have some, and that could be a 3-hour conversation in itself. I understand that, but just some real core things to be thinking about and some traps that maybe people miss when they're thinking about after-tax proceeds from a sale.
Yeah, so I'll preference this. I'm not a tax expert, but I know enough to be dangerous on the transaction side. So generally speaking, selling stock is more advantageous to the seller than selling assets. And the reason for that is the prior administration, I think in 2018 or 2019, I can't remember the date, changed the tax code where capital gains rates were brought back down to 20% versus ordinary rates, which were around 35 and up. So there is an arbitrage there between the ordinary and the capital gains rate, as long as you've held that asset for more than a year. Now, with that being said, there are some specifics based on entity that drive this conversation. You will rarely ever see a C Corp sell assets, and that's because of the double taxation. So 99% of all C Corp acquisitions are done on a stock sale. Once in a while, you'll see a C Corp sell assets, but there's typically something else going on there, off balance sheet liabilities, environmental issues, things that the buyer doesn't want to take. So on a C Corp, if you are a C Corp, the only real way to structure it is through a stock sale if you want preferential stock treatment on that, or tax treatment. If you're a flow through, LLC, S Corps, LLPs, typically it's still advantageous for you to sell units or stock, but you will see buyers come in and ask for a step up in the basis of the assets. And so there are some unique ways, more complicated ways to do that, where both buyer and seller get what they want. Typically in that situation, and Brad can talk to you about the technicals of how to do this from a legal perspective, but there's 330H10s on the S Corps. There's F reorgs that can go on. there's a lot of technical tax and legal jargon that kind of go into that. What the real takeaway, I think, for this group is if someone approaches you and they're interested in doing an asset sale, you should be made whole for that. And what I mean by that is there's typically two scenarios run. There's the scenario where what do my proceeds look like if I sell my stock or my units? And then there's what does the proceeds look like if I sell assets? That differential can be made up through a purchase price adjustment upwards. And that'll get you whole on the tax difference. Now you typically would need your CPA to run that, or your advisor, your CPA advisor on the acquisition. But they should be able to pretty easily calculate what those differences are and get those proceeds added back as a purchase price. The reason why that's valuable to the buyer is because they get to take the depreciation then on those assets going forward. And since there's an arbitrage between the 20 and the 35% basically ordinary tax rates, it's more valuable for them to get the asset step up and take 35% deduction from a tax perspective and pay more for the business. Now, the caveat to this is that if they change capital gains rates back to match ordinary rates, then it doesn't really matter. But right now, at least the way the tax code is written, that there is an arbitrage there that does work for both parties. Brad, any questions on that?
Yeah, no, I totally am with you about yeah, it's like, you know, the interests of the buyer and seller aren't like exactly opposed always in this part of the conversation, but they, you know, to your point, they don't always line up. But I totally agree about working if buyer wants, you know, one structure and that has more expensive or negative tax impacts for you about the true up. I would also sort of, to a point that's been made a couple times already today, like get that in early in the conversation. Don't find yourself late in the day trying to retrade that, because you know, you ask for more purchase price towards the end, even if like logically it makes total sense, you're going to end up having to give something else up usually. And so you would like to have that lined up earlier in the conversation, if at all possible. And like Corey said, there are some workarounds within the tax code that can kind of allow everyone to get what they want, but sometimes that does have costs to the seller in particular. And yeah, I agree. I mean, you should be made whole. Not all buyers see it that way, but we all agree that.
This is where it really pays to have an advisor and an accountant, CPA that is really versed in transactions. Is that a fair statement?
Yeah, totally.
Okay, perfect. So Brad, I'll kind of segue to you for a question as it relates to post-sale for a seller. And is it typical for the seller to remain involved in the business for a period of time? And then, you know, what about non-competes and any delayed payments? What do you see typically?
So yes, I think would be the answer to should a seller expect that the buyer will want them to hang around for some period of time? Even if that's, you know, a few 6 months sort of for a transition, but oftentimes we see people enter into an employment agreement for maybe a couple of years because, first of all, because the buyer understands that person has real value, whether it's in the way they've operated the business or connections in the industry or ties to certain customers or employees. Whether the principal of the seller always makes it through that 2-year period, it's sort of a different question. Right. Many of you, you've gotten your payday, hopefully, of a meaningful amount for you. And a lot of people in this position, certainly I assume a lot of people on this call had their own businesses because they didn't want a boss. And so now you have a boss, and even if they're the greatest boss in the world, they still are your boss. And so, that sometimes people buck back against that. And it's not even like there's no like anger tied to it or real strife. It's just sort of like it's time to go our separate ways, and that's fine. The thing I would say though is if when we talk about delayed payments, whether they're a promissory note or an earnout, it's nice to hang around if you can, because that allows you both the opportunity to kind of hopefully maybe influence the success or the likelihood of you making those payments, or you receiving those payments, or the company making the thresholds that will allow you to get the payments. And also it likely gives you a different kind of insight into how the company is actually doing, and whether they're complying with what they're supposed to be doing particularly under an earnout. And you can and you will provide for a lot of that within the legal documentation to say, I get certain rights to see the books, and you guys can't do this and can't do that to try and make sure I don't get my earnout and that kind of stuff. But it's different to be there and to have a real sense of what's going on. As far as a non-compete, I would say almost always a seller, either the entity and the principal, the owner of the seller, or owners of the seller, can expect to be presented with a non-compete as part of the transaction. In most states, in certain states you can't. But even in a lot of those states, you can. There's a carve out for sales of businesses, and even under this proposal from the federal government right now to possibly ban non-competes, there are certain carve outs for sales of businesses. Because that's just sort of a different concept and not why they don't like non-competes. Because I do think most people would acknowledge that it's fair for a buyer who's paying a bunch of money for an entity or an asset to get the value of their bargain by making sure the person they just handed a bunch of money to doesn't use that money to turn around and set up a competing business. Non-competes themselves and the employment agreements themselves, getting back to what Corey was just talking about, those can have some tax impacts to the way you get taxed on part of sort of what are essentially proceeds. So you'll want to take that into account. But yeah, I think on the non-compete, for some people, if you're truly retiring, then, sort of who cares and fine. Mm-hmm. For a lot of people though, this may be their first bite at the apple and they want to go plant a different tree or whatever and grow some more apples. And so, I think you'll want to understand it. And they can be very technical, and you want to understand sort of what your restrictions are. I guess I would note that as a seller, if you start to push too hard on the non-compete, it might give the buyer some heartburn about, well, what are you planning on doing? And then when you get to that part, I often find, just as a tip here, if you have specific stuff in mind that you want to do that you're worried might be on the line, but kind of they don't really care about, instead of asking or making comments very broadly about the terms of the non-compete that might give them concern, it often works really well to just say, hey, look, here's a list of things I want it very clear that I can do. And that oftentimes is much easier of a conversation than trying to have broad conversations about the language of the non-compete. If you can just come up with a list of here are the 4 things that are okay, that usually can get people comfortable much more quickly in my experience.
Michelle, if I can just step in, you have probably just a couple of minutes here until we wrap up to head into the breakout rooms.
Great. Thank you, Sarah. Appreciate it. Corey, did you have anything else that you would want to add to that piece? I think Brad did a nice job.
I would say that, all of that above is all negotiation, and, to get ahead of that, pre-LOI or at the LOI stage is in everybody's best benefit. So.
And I would just add, I think Brad alluded to it with a smile on his face, but it's pretty difficult. And I'll tell you, I'm not even sure that I can name a seller that even if they've negotiated 2 years, that has actually made it to really saying, even at the end of that 2-year timeline, being fully engaged or wanting to be a part of that. And oftentimes they negotiate an early departure. I think that it's also very difficult not only to have a boss, but even if you think it's the best buyer in the world, they're going to change some things. And so you're looking at it, you're going, I built this baby and they're changing that. Oh my goodness. And it's really that's where we get into this emotion that we've talked about previously, is you get past all the math and the computations and the negotiation of the sale. And then you get into this emotional thing again, especially if you're coming in every day and it doesn't feel quite the way you thought it was going to, which in many cases it won't. So this is an awareness piece. But with that, I want to stay on track. I think you're going to move us into breakout, Sarah.
Absolutely. Thank you so much, Michelle, Brad, and Corey. You guys were amazing detail is so incredibly helpful. You have definitely helped not only educate our WBEs, but also us with the WBDC. So thank you so very much. At this point, we'll transition into those breakout rooms. They'll be approximately 20 minutes long. The first one will be with Corey, and he'll be there to talk about tax related or accounting related questions that you might have. Brad will lead the way on legal matters, and you can just go ahead and move yourself into the room you want. If you are struggling with technology issues, we have
Great. Well, this has been incredibly helpful. Brad and Corey, you have shown us again the level of expertise that you bring to this space and the level of understanding as it relates to really beginning to work through a transition with clients and really understand the nuances that people are going to face. I think that's one of the things that stood out to me today is clearly this is a complex, transactions can be very complex, but you get the right advisors on your team. And I think for all of you, you're doing the work now to clearly identify the objectives that you have in place. And I think first and foremost, I would say that's really important. We can talk about the nuances and the legal structures and the tax implications, but at the end of the day, what are you trying to accomplish? And what's most important with the objectives that you have. Going to an external buyer, it probably is more strategic in the sense that you're looking for maximizing your price. And then you start to work with professionals to understand what that looks like, to really seek out strategic buyers, private equity firms, and get the gambit of what's available to you. So if you're in front of that, that's really helpful. Brad said something else earlier that I really believe, which is you usually end up, it's kind of like marriage. You know, you end up marrying someone that knows someone or has some sort of common ground with you. It can be pretty scary, especially if you're working with people in the industry that you've competed with for a while, to think about that, but they may be your best buyer. So you know, really looking at what's right for you, what's right for your business, and what's right for your employees is a big part of this, especially when you're going to an external buyer. So again, I just want to thank all of you for attending today. And Brad and Corey, you did an excellent job. And as Karen said, our contact information is available for you. I'm sure that any one of us is happy to you know, take your call or field a question down the road if you have additional things that you'd like to discuss.
Thank you so much. So on behalf of the WBDC, I want to thank everybody for joining us so far. One of the things I think that you've been taking away from this is just the importance of trusted advisors, and with the WBDC are so view ourselves as so fortunate that we have trusted advisors and partners like EisnerAmper and Barnes and Thornburg, our speakers, and then people who've spoken in the previous sessions as well. If you are registered for this event, which you are because you're on the call, then we also hope that you will join us next Thursday, the 16th, same time, same station, same Zoom link, to talk about how selling a business can impact your WBE or other diversity certifications. And so that we will have a couple of experts on certification, an attorney from the Chicago area, Michelle Cantor, and also our director of certification, Bridget Foster, and myself, and we'll be talking about all that. So as Michelle said, we'll be following up this email later this afternoon, or I'm sorry, this session either later this afternoon or tomorrow morning, with a copy of the recording and our panelists and speakers contact information, although you can also see it here, but you'll be getting it in your email as well. And I just want to say thanks for joining us. Thanks again to Michelle and Brad and Corey for a fabulous program, and everybody have a great rest of your day.
Thank you.